Silicon Valley Bank collapse. Apparently, it's easier to talk when your mute button isn't on. It's a big deal right now. It's all over the news. So here's the question: how does that affect you? How does that affect small business lending? It's actually had way deeper impact and a lot of ripples going through the industry right now, from the fintech space to major banks as well. And so, what we're going to cover today is how is this going to affect you? What can you expect to happen? We're really talking about multiple banks now with SVP, which again, I will refer to Silicon Valley Bank as SVP throughout the rest of this training. And again, we're also looking at Signature Bank as well. So we've got multiple banks in serious trouble. And as a result of that, we're seeing ripples through the industry. But here's the question: how does it affect you? How does it affect your ability to get money? Well, that's exactly what we're going to dive into right now. So let's dive in. First of all, hey, it's here. I told you. I've talked to you about the last year and a half and said this financial uncertainty is going to create problems. It is going to wreak havoc throughout the business lending space. And that's exactly what we're now seeing. Now we're all seeing what, if you follow us here, what we've been talking about for over a year and a half, stating that these exact same things that are happening would be happening. And that's exactly what we're seeing is, with SVP actually going down and now Signature Bank, again, we're seeing that this has ripple effects throughout the industry. So what does all this mean, or how did this happen? Let's start there, I guess. So first of all, we're all familiar with inflation, right? And what's happening with inflation right now. Well, ultimately, inflation just kind of hacked away at SVP's holdings, and they really realized that they just basically didn't have enough to cover the demands for money, right? And that's what happened. So ultimately, they started selling off holdings, and as a result, and as part of that, they actually made reported that they had this issue as well. Then there's basically a run on the bank. Once that becomes public, that they're basically selling off assets and selling things to basically cover the demand, then what happens is at that point, it becomes public information. And then it creates a run. Now, you've probably heard about a bank run. The word's been thrown around. The language is being thrown around right now. And what a bank run basically is people start taking money out of the bank, right? That's what actually is going down, is they're actually coming in and withdrawing money from the bank at a very, very, very high rate, right? When there's uncertainty, anybody that's got the money there wants their money out. Even though we see this, that these are FDIC insured, and what that means is it means that, if somebody does have deposits in there, well, then they kind of have the assurance from the government that they're actually going to be able to get their money back. But, I don't know if you've ever dealt with the government. They're not the fastest to deal with, especially with handing out money in situations. We saw this in PPP, along other things, with massive delays and problems. So again, nobody wants to get caught in that trap waiting for money to actually get through the government to get to them. So what happens is it creates what's called a run. And a run is basically where people start taking money out of oftentimes that bank and all banks, right? Because one bank collapse creates confidence issues with the rest of the banking system. And we're seeing a lot of this happen right now. We're going to dive into that because your bank has probably been affected. Mine is. I deal with Regions, and I think within 24 hours of this news coming out, Regions saw a massive drop in their value, in their stock value. And again, I think it's rebounding. A lot of them are rebounding. A lot of them aren't rebounding. But again, some things to keep in mind. So ultimately, inflation is really one of the main causes that created this. Then as they start selling assets, then what happens is they have to report the issue. Then it becomes public. Then it basically creates a run on the bank. And that's when the FDIC steps in, because they're pretty concerned that they're talking about billions of dollars, especially $1 billion plus, I think, that was in question. And as a result of that, the FDIC comes in, the government comes in and basically takes over the bank, which is what we're seeing. So very, very, very fast. And that happened because, in part, SVP's depositors simply just withdrew their funds online. And that's really interesting. We haven't really seen this before, where we're now in a world where banking is happening so much online that you don't need to go into a branch to pull money out, right? That in itself causes a delay. Everybody should know that, banks only keep a certain percentage of money, like in the bank. If you ever try to go get a 50 or 100,000 or 200,000 out of your bank, they're going to tell you, we can't do that. We don't have that money in this location. And if you watch TikTok and YouTube, you'll see people do this all the time to try to prove points, where they go to their bank to take out 200 grand, and the bank's like, we don't have the 200 grand. We can't give you the 200 grand. And they're like, see, it's mass panic. The banks don't have the money. Well, the bank has to get it from other locations and bring it in, because they only keep so much cash in hand. So if you have to go to a bank to pull money out, then what happens is it creates this delay, because if you go to your bank today to get 200 grand out, well, then your bank's like, I don't have the money. I need a week to be able to get the money from other locations here to be able to give you that 200 grand. But what we're seeing now, which is really interesting, is your ability to get the money out virtually to be able to pull the money out virtually and move it into other things that you can move it into where you don't need to actually physically deposit or withdraw the cash. Okay. But again, if you're creating a run on a bank and you don't think the bank has the funds, you're going to want the cash. You're not going to want a cashier's check from them, right? You're not going to want anything else from them other than the cash because nothing else is going to give you that peace of mind. So this is what caused it to happen so fast, this run on SVP, because what ultimately happened was people were able to go online and just start pulling the money out of their actual bank. And as a result of that, it created a very, very, very fast situation where SVP went down. And now they're not the only one here. We're also talking about Signature Bank as well. Now, Signature was really in a similar position. But the interesting there is they were also a favorite bank of like wealthy depository institutions as well. And they were one of the first banks to accept crypto as well. And it's unclear, but it's possible that some of the owners of the businesses were actually the depositors with SVP had their own personal money in Signature as well. It's actually pretty interesting. One of the things I thought was really interesting was when this all came out Friday, you saw SVP's main people, they actually pulled out bonuses. So they're actually pulling money out from bonuses from the bank as the bank is literally in the process of being taken over by the federal government. So we'll see how all that plays out for them. And by the way, if you have questions along the way, go ahead and type them in the chat. And if you don't mind, give me a shout out. I'd love to hear where you're coming in from. I'd love to give you and say hello as well. So here's the question. Is this going to continue? Are we going to see more bank failures? Because we've been talking about this for a while and now the trend has started. But the answer is, nobody knows for sure. What we can say is possibly a number of regional banks like Zions Bank, for example, in Utah, saw stocks drop dramatically. And as a matter of fact, it's not just regional banks. We saw major banks this exact same thing happen to. Like I said, Regions is where I do a lot of banking as well. Their stock dropped dramatically as well. And a lot of them started seeing these significant declines in stock value as of Monday. But then again, a lot of them started their rebound on Tuesday. So a lot of banks that come to mind here, Zions, Western Alliance Bank Corporation, Metropolitan Bank Holding, Customers Bank Corp, and even Key Corp were kind of affected by this as well. So Western Alliance, Metropolitan Customers, and Key Corp have all seen their shares fluctuate wildly over this week where they saw these steep declines. Then they kind of started to rebound a little bit, and it's just kind of been a little bit up and down. So what we're seeing now is this wave through the banking industry that is having very, very big ripples throughout multiple banks. We've even talked to people that help our clients secure corporate credit cards and even talked to major banks like Chase, Bank of America. And what's happening is they're all in, I don't want to say panic mode, but they're all scurrying around. Nobody's doing a lot of anything beyond trying to deal with the fallout and the impact of this. So it's kind of crazy when we think about that. One bank has problems and then it immediately carries over and another bank has problems. And now the entire industry really is being adversely affected by what's going on. And hey, Churchill, thanks for coming in. Hello from New Jersey. I appreciate you saying, hey. Fuzzy Vlog says, what about lending institutions like Rocket Mortgage? Are they a good source? So we're going to jump into that. I'm going to actually answer your question. The short answer is fintech hasn't been affected as much as what we're seeing the ripples through the big banks. So when we think about Chase, Bank of America, the major banks are definitely seeing a more adverse impact from this than what we're actually seeing happen with a lot of the fintech lenders out there. So again, right now, the fintech lenders seem to be, a little bit safer, a little bit slower to have a negative response than we're seeing the big bank. Hopefully that answers your questions. And Maryland, good afternoon. Finally, the corrupt, rigged banking system is imploding. Maryland, a lot of people are saying the same thing. And I was just talking earlier about how people tried to prove this point by going in to take cash out of the bank for the bank to say, we don't have that cash on hand. You're going to have to come back at another time. So again, these are the times that becomes really a problem where you might struggle to be able to get your money out of the actual banking system. And Churchill, thanks for coming in. Credit Suisse is also the same bout. They're looking for a $50 billion bailout, says Churchill Coins. Look, this is interesting because, again, when we see these record high interest rates or interest rates climbing, I don't want to say record high because they're not, but I don't know if it's ever happened. I don't think we've ever seen rates increased so much so fast as what we've seen here in the United States alone. And again, this is happening all over the world. A lot of countries around the world are having the same problem with banks in their country as well. So this is not just happening in the United States. This is happening across the world right now. And Churchill says hello as well. And Mad Max says, hey, how does this affect business credit in the future? We'll talk about that as well. I'm going to specifically talk about business credit as well. So commercial a lot of these commercial banks had losses, but less fluctuating as they started to kind of bounce back up. And Moody's, this is a really big thing, has actually downgraded the entire rating of the U.S. banking system from stable to negative, citing a rapidly deteriorating operating environment. So to go to show you the severity of what's happening right now, that's just a big explanation point of Moody's saying, hey, look, we're downgrading the rating of the entire U.S. banking system from stable to negative. So that's how big this is. Now, I'm not trying to sit here and drum up a bunch of panic. I'm not here, right? Anybody that follows me and has followed me for a long time knows I'm just here to state the facts. I'm just here to answer questions. I'm here to talk about what's actually going on. I'm definitely not wanting to be any part of an overall run of the banking system where everybody's going to pull money out. Look, that's what everybody's worried about right now, right? What happens in these situations is it causes a run, not just on the banks in trouble like SVB, but it also causes a run on the entire banking system where people lose confidence overall and start pulling money out of all of their banks, even if they're not directly linked to SVB. Not trying to have anything to do with that. It's not in my best interest to create a run on the banking system because those banks are the ones that provide credit and financing to the business owners that we want to be able to get money, right? But I am just here kind of reciting the facts, talking to you a little bit about what's happening on. So we've already talked about fintech, and so far what we're seeing is that fintech has been doing okay. We're seeing that they've actually been maintaining what's going on, except for Signature and SVP. Obviously, they really had some problems there. But fintech is actually in a better position than what we're seeing the major banks struggling with right now. Now, SVP was actually kicked out of the S&P 500 and is being replaced by Insulet, which is basically like a medical device manufacturer. They took their place on the S&P 500. So we've already seen SVP fall out of that, which we would anticipate would happen now that they are being taken over while we're trying to figure out what will happen from there. And Signature Bank has also out and is being replaced by Bunge, which is like an agribusiness and food company. So what's happening, of course, is you got, the S&P 500 is the top 500. And when two drop out, then the next two that would be in line to get in there are moving in there. So it doesn't really matter who replaces them, but we've already seen these two fall out of the S&P 500, just more fallout from what's actually happening here. So here's the question. How does this impact small business lending? Well, as I've said for 2 years now, you're going to start seeing a tightening of banking regulations. And this is why I've tried to create so much urgency on these live streams of getting the money while you can. I talk about how we went early last year and got an SBA loan, not because we even needed it. Literally, the entire loan is still sitting there in our actual bank account. But we went ahead and got it because we saw interest rates skyrocketing. We saw the instability. We knew that these things were going to happen. And these are the type of things that we've been talking about on these live streams, trying to kind of bring the education to you. Now, Anthony says, hey, what happened to the 5 C's to credit? These huge banks should not judge character, situations, capacity, capital, collateral, conditions, and character. What a learning process. Yeah, it really is interesting. And again, we're learning a lot about how banks do business, about how exposed that they actually are, and how exposed we all are when we're actually dealing with the banking system. I think, don't hold me to this, but I'm pretty sure the banks are only have to have the ability to access like 10% of the depository funds at any given time. So this is why they're very vulnerable. If everybody starts pushing to pull money out, they just do not have the funds available. That money is invested elsewhere. That's how banks work, right? And we've also heard about like whole life insurance policies and being your own banker. And this is what oftentimes happens. The reason for that is because when you invest in banks, bank takes your money and they invest your money. That's how they actually get their rate of return, right? They take part of that money and they put it out in loans and things like that. And they're also investing the money into other things as well. So again, they don't have a lot of the cash on hand for people to come in and create a run and be able to pull a lot of the money out. Till Young says, impressive work construction in St. Louis. Thank you very much for coming in. And how are credit unions affected? Well, we're seeing the impact kind of happen like this. We're seeing that banks are the most adversely affected at this time. They are really up and down. You don't have to take my word for it. We can run, look at the stocks of any of the major banks, and you're seeing what's happening. Typically Monday, they started a very deep decline with a lot of them, and then we started to kind of rebound a little bit, and now a lot of them are kind of returning back to a little bit more stability than what they had, okay? Because what happens is a lot of regional banks, like Zions Bank, for example, they saw their stock fall dramatically, but then rebound on Tuesday, because what's happening is investors are looking for bargains, right? Okay, I mean, the people that will tell you that are the smartest investing, that, you know, when people are panicked and people are selling and values are going down, that's when they're buying. So what's happening is there's this whole wave of very wise investors that are watching this happen and coming in and grabbing the stock when it's hitting these new lows, because they feel confident that things are going to rebound. So we're kind of keeping some balance here, where we're seeing these steep declines in the value and the stock value of a lot of the big banks. And then these people that are very wise that are coming in and then taking, I don't know if they're wise or not, maybe it's not a smart call, but they're coming in and grabbing things on what they believe to be the bottom. And that's actually bringing a lot of the values back. So we're starting to see a lot of the stock values actually rebound with these banks in a very short period of time as well. So how does it affect small business lending? Well, as I said, what's happening is we're going to start seeing a tightening in banking standard, and we're going to see banking regulations tightening too. So let's take a look at this. In 2008, I'll give you a real example of what this means. In 2008, we saw a lot of the problems of the banking system, obviously, with the mortgage collapse. And as a result of that came a law known as Dodd-Frank. And Dodd-Frank made it harder for banks to be able to lend money and issue credit. And as a result of that, in the aftermath, in the years after, we saw a 15 to 20% decline on limits that banks would issue. So if a bank would issue a credit card in the past for $10,000, now they were only issuing that exact same credit card under the exact same circumstances for $8,000. That's really what happened. So again, this is what happened when regulations come in. First, we see banks tightening up, right? And I'll give you an example of this. We submit a lot of programs. There's a program called Credit Line Hybrid. And as a result of that, a lot of the lenders out there that deal with that, are the funding sources, they submit applications for clients to the banks for credit lines. And the easiest way to get that done is to have a manual underwritten process, or a manual submission from a representative within the bank. So a lot of people with that issue that are a lot of the financial sources that handle that program, Credit Line Hybrid, what they'll actually do is, instead of just having a client or submitting the application online for the client, they'll contact a source in Bank of America, Chase, whatever, and they'll have that internal person submit the application themselves, because applications that are submitted internally have a significantly better chance of getting approved than ones that aren't submitted internally. Well, those bank reps are shutting everybody down right now. They're like, look, we can't even deal with this right now. We're trying to deal with the fallout. We're trying to deal with the impact of this. So we're starting to see a lot of that already, whereas the system and the disruption to the system is already creating delays in business owners' ability to be able to get money from those banks. Not pull their deposits out, but get loans, get credit lines, get credit cards. So we're already starting to see this, where applications that those of us that are in the industry and in lending had these insider tracks with people within the banks that would submit applications. Those people aren't even talking to anybody right now. They're like, look, we need time to try to dig through this. This is the topic that we're all trying to deal with right now. So we're already starting to see that banks are basically pulling back with issuing credit cards, credit lines, issuing loans. It's becoming already in the short term a little bit more difficult to get money, because a lot of these banks are on hold trying to figure out what's happening. And by the way, exactly same thing happened in 2008. What we saw in 2008 was that eventually banks would pull everybody's credit lines. If you were only spending $5,000 on your credit card and your limit was 50, they were lowering people's limits to what they were typically spending. So they'd lower it to $5,000 because they needed more money to be able to still continue to lend. So that's not something that I think is unexpected for us to see. I think if you are paying attention, it might not be unexpected to see your credit card limits drop, your credit line limits drop, even bank amounts that are being lent drop in the short term. This isn't, I'm not saying it's going to happen. I'm just saying we have history here. I mean, it wasn't that long ago that we went through the 2000. We've seen how this plays out. So what's happening now, it follows a very similar trend to what we saw then, which is the fact that, first of all, banks tighten up. So that means that it's harder for us to access credit lines, credit cards, and loans. And by the way, this is what I've been saying for the last 2 years. You need to get in now if you haven't already to try to get whatever money that you can get that you may need to grow the business, because it's only going to become more difficult. And the reason it becomes more difficult is because first we see this tightening of bank standards. The second thing that follows that is eventual regulation, right? What happens is there's outcry, people freak out, they complain, and then bureaucrats get involved, and then the laws are passed, right? And we saw this with Dodd-Frank. And then that law said, okay, it's harder now for banks. You got to be tighter on what you're doing. You got to be stricter on your guidelines. You got to be more strict and more restrictive of who you underwrite and give loans to, and more restrictive of the amount of money you're giving out. So then government comes in, and then the regulation takes effect, and then overall across the board, we start to see lower approvals, and we start to see lower approval amounts. And this is exactly what we saw in 2008, where we saw people get their credit lines pulled, their credit limits from their credit cards reduced, basically to make room to still have that money to lend out. Banks basically were more conservative. They even stopped a lot of the lending completely, almost completely, for a short period of time till they kind of got things figured out. Then as they started to ramp back up, then government comes in with regulation, and then it levels off at a point that's way less than what people were typically getting. So people are now getting approved, but they're getting approved for less than they were before that time, and that regulation came in. The regulation permanently changed the amount of money that business owners were getting at the time. And that's exactly what I think that we'll see here too, is I think that the immediate pullback from banks makes it harder for us to get money in the short term. Eventually, they'll start to open back up as they always have. But the problem there is more than likely regulation is going to follow. And what's going to happen there is that's going to permanently reduce or permanently reduce the amount of money that we may get from the actual banking system. Some things to think about there. So we're also going to see lower risk be easier to get money than higher risk. So we start to see from the banking system in general, it's going to be harder to get money, period. So maybe some of those borderline deals that they would once do, they're probably not going to be doing. What they're going to be doing is focusing on their best clients. They're going to be focused on the people that are the lowest risk, that have the highest credit scores, that have the highest business credit scores, for example. So we're going to see a lot of that happening more than likely as well. Now, Steven says, hey, do you think existing credit lines will be cut? I'm not going to tell you what I think, but I will tell you this. Well, here's my opinion. We've already seen this happen. This isn't new. It's not like we're trying to decode a mystery of what we've actually of what might happen. We've already seen this happen before. And if the credit is issued from a big bank and banks tighten up, then what happens is they need to free up funds to be able to lend to other people. And where they typically get the money and they free up the funds is in unused credit lines and credit cards. So I am absolutely not suggesting that you go max out your credit cards and credit lines. But what I am saying is that if you have a $50,000 credit line, for example, and you've only ever used $5,000 of that limit, you got problems. You are very well susceptible to seeing credit line decreases, as we saw in 2008, because again, the banks are going to try to free up money, and the easiest place to free up money is credit they've extended that is not being used. So that is a question, Stephen, is yeah, I do. I think that you're going to see unused amounts of money on credit lines reduced. I don't think it's surprising to see more people getting their credit lines pulled altogether. I think banks are going to start looking again at the money that they already have outstanding. And I think that results in a few things, including you're going to see a lot of credit lines reduced and a lot of credit lines called due. And what that means is it means now they're going back to evaluate what's in their portfolio, what's outstanding. And then what they're basically going to do is they're going to look and say, okay, hey, look, should this person's business credit profile and scores have radically changed? Should they even have a credit line? No. Well, then call it due. And so if you've got credit lines with a bunch of money outstanding, I don't think it would be unexpected to see if your risk status they would then call the line completely due. And those people that have credit lines outstanding that they're not using a large portion of the limits they have, I think it's completely reasonable and expected that you will see banks start to lower those line limits down to closer to what the person is actually using. And that helps them free up money that they're still able to issue to other people that are applying for new financing. So yeah, these are things that I think will happen. I think they already have happened before. We've already got the benefit of experience with seeing exactly how the banking system reacts to this as well. And Till says, hey, yes, you're only informing and not advocating, but being pessimistic. Blessings. And I'm pretty much an optimist. But again, the nice thing about being where we are is that we've already seen this all play out before. So again, it's not like something that we're really surprised about, because this is exactly what we would anticipate happening. So what will happen? Well, first of all, business credit is going to be more valuable than we've ever seen before. What we saw in the large part was that the consumer markets were hit more than the business markets in the 2008 crisis. And I think that's what we can expect to see again. I think that as the banking system itself tightens up, I think that we start to see that business credit becomes more important. And the reason for that is that a lot of business credit is not necessarily underwritten or backed by big banks like Bank of America or Chase. Okay, so and some is. A lot of it's underwritten by Citi, for example. So I think that if you have business credit, it becomes more important than ever before, because again, whatever money you have now, it may be harder to get access to more money in the near future and even further into the future. The other thing to think about is that you really need to make sure that any money you need for your business, you need to start getting right now. I know you might think now's the worst time because we just had SVP go down. We just had this happen. But the reality is this is just the beginning. We're going to see this happen with more banks, because you're going to see a run of some sort on the banking system. Meaning you're going to see more and more people starting to withdraw as they lose confidence, and this starts to take over more and more and more of the news cycle. And as that continues and those waves, those ripples through to other big banks and other regional banks, you're going to find it only more difficult in time to get access to money. So you really need to start jumping in and thinking about the money that you need right now and getting approved. Let me see. I think I have like a QR code or a way that you can actually, I'm going to throw something on the screen right now about that. If you are interested in getting funding, right, here's a link you can go to on our end. And I said comprehensive business credit. God, I didn't want to do that there. Okay, this is actually an easy way where you can just go to this link right here that I threw up on the screen. And this is a way we can start talking to you about getting approved and the money that you're able to get approved for right now. Because again, I'm not trying to create some false urgency here. We've already been down this road before. We already see what's going to happen. It's going to get more difficult as regulation comes in, as banks begin to tighten up, as this ripples through the industry. It's only going to be more difficult to be able to access money. The good news is that fintech really hasn't been as affected. So when we see these alternative lenders, cash flow financing and merchant cash advances and credit line hybrid is still one of the easiest ways to get 50, 100, 150,000 in credit lines. We're still seeing approvals be where they typically are for that program. So we're still seeing a lot of fintech type of lending programs that are still very valid. You probably want to maybe not have you're probably not going to have a lot of success through the big banks right now, but fintech is still a very, very viable option for you to be able to get money. And a lot of the small business loans right now remain intact from fintech lenders. And we're not seeing a big pullback of lenders when it comes to even the major banks with SBA, et cetera. But again, I think that we will see that if history repeats. I think we'll begin to see that, especially as we saw a lot of that in 2008. So if we can help you along the way with getting money, I put that link on the screen. And we're still in very, very, very close communication with a lot of our lenders. We actually worked over 1,000 lenders. And I can tell you that even through 2008 mortgage crisis, even through COVID, I'm texting, my phone is blowing up constantly. And then I'm just constantly in this process of working with everybody and communicating openly within the actual environment to see what's going on. And as a matter of fact, I've kind of started to create a mastermind for this purpose of all these people across these different industry sectors in business lending, just so we can have monthly updates about what's happening, how it's affecting the industry, so we can actually keep our ear on our finger on the pulse per se and know what's going on. But right now, the good news is we're still seeing approvals pretty equivalent to what we've always seen in fintech. We're still seeing cash flow financing and credit-based financing and stock-based financing. We're still finding a lot of this go just normally as it should. But that's what we saw happen before. And then we started to see changes through time. So my advice is that if you've got credit lines, if you've got credit cards now, you really want to be thinking about using that if you don't want to lose a large part of the availability that you have. I'm not saying go max out credit cards or credit lines. What I am saying is that if you've got a credit line with a big limit compared to what you're actually using that line or card for, and now might be a good time to start putting some activity on that line or on that card to show them that you are going to use it, because the first ones that go are the ones not being used. The second one to go are people that have high limits that are not using even a portion of those limits. I would start showing some activity on those lines that you have. Otherwise, if you need money and you know you're going to need money for your business this year, you really want to take a step right now to start securing money. Because as this trend continues and we see these ripples go through, you're going to see it becomes harder and harder and harder to get money. I've told you this 2 years ago. Now you're seeing it happen. Been talking about it for 2 years since. And again, now we're starting to see it happen. So now is the time to get in, because it's only going to get worse. And also keep in mind, if you're going to get money right now, fintech seems to be a pretty stable place. Not saying it'll remain stable, but it's more stable than what we're seeing with the big banks. So if you're struggling to get credit cards or loans or credit lines from the big banks right now, which you may, because everything's kind of on a hold in a lot of places, then you're still probably going to have a lot of success from the fintech, the alternative lending side, where we're looking at cash flow or credit or collateral to get you money instead of actual money from the banking system like SBA loans, which are going to become harder to get. So that's some of my best advice for you as well. And I don't know if I think I'd answered everybody's questions here too. So I'm going to probably go ahead and wrap up. Again, the key here is that now you have a kind of an idea of what caused this to happen. What happened with SVP? What does that mean? What are we seeing with the ripple effects of this with regional banks and big banks? What are we seeing historically happen here? We've discussed that. We've talked about the existing loans you have, the lines you have, the limits you have, and how those are probably going to be affected as well. We've talked about regulation. We've talked about a tightening of guidelines and standards that we expect to see from banking from all of this as well. And then we also got away from the doom and gloom, and we talked about a lot of solutions, which is fintech, alternative lenders, credit line hybrid is a great way to go. Cash flow type financing using assets and collateral-based financing, probably still a safe place for a while to stay, but not to say that we're not going to see some kind of disruption there too. We very well may be. But again, the good news is that on the lending side for businesses, we're not seeing a big adverse impact right now. But again, I think if history repeats itself, we will. So if you want money, now's really the time to jump in there and to be able to grab it. And by the way, if you're interested in coming in and making money in the business of helping people through this process, then don't forget, we've got a challenge going on right now. And with the challenge, it's called the Business Loan Broker Challenge, where you can actually become a business loan broker. Okay. And with that, you're actually able to come in and actually help people through this process of being a business loan broker to be able to help them get money. And it's very lucrative for you, and it's a very big reward for the business owner that you're helping as well. We've seen more of our partners succeed offering business credit financing through everything that happened in COVID than ever before. It creates a major spike in demand, right? Because that's how everything works. It's supply and demand. Now that everybody's freaked out that the supply of money is retracting, then now the demand will increase. And so what happens is more and more people are pouring in that want money. And we saw this happen during 2008. We saw this happen during COVID. Okay, this is the trend that continues. So the demand for money really goes up. So as a result of that, then what we want to do is we want to help as many people as we can. And an easy way to do that is to offer business credit financing as a service. So if you have any interest in that, we have a 100% free event happening called the Business Loan Broker Challenge. You can go right here to this link on the page, or businessloanbrokerchallenge.com. And then from there, you can actually get in the industry 100% free. We teach you everything you need to know. The lenders they actually sign up with will be right there for you as well. And you can actually be part of the solution here, because we're just getting started. This is going to continue. And as we continue to see the conditions worsen, then what's going to happen is the demand for money just continues to skyrocket. And it's an opportunity for you to be able to help more people with business credit and financing. And also as well, it's a very lucrative primary or secondary business for you. So I'm going to go ahead and wrap up. I think I've made sure that everybody's questions are answered as well. For any other help with this along the way, any questions, you can reach out to us, info@creditsuite.com. Follow us. We're going to be doing video releases, 1-minute videos, longer videos. We'll be diving into this topic aggressively in the weeks and months to come. So make sure you go to creditsuite.com, like and subscribe on our social channels. We'll be keeping you informed of what's happening with SVP and the rest of the banks that will be affected by this. Because again, it's going to cause a run in some which way or form, and that's going to affect other banks. We're already seeing that happen. So keep an eye on what's going on. Make sure that you are actually coming in and giving us a follow, and we'll keep you informed of what's happening. So thanks for tuning in. Hopefully you got a lot of good, valuable information and some actionable steps out of this, of how to navigate this. And we'll be keeping you informed as we continue to report on SVP and what's happening with the ripples of this throughout mainstream lending and also through fintech as well. Thanks for tuning in. Have a good day.